Ah, inflation, that pesky financial gremlin lurking in the shadows, ready to pounce and wreak havoc on our wallets. But before you start hoarding canned beans and gold bars, let's take a humorous stroll through the current inflation landscape, guided by the ever-optimistic Tom Lee, the market's very own cheerleader. First up, housing. Despite home prices stabilizing and rents getting back to their usual sluggish pace, the Consumer Price Index, CPI, insists on reporting these costs as if they're still partying at 6%. It's like the CPI is that friend who just can't move on from the good old days, still rocking out to 80s hits at full volume, while everyone else has moved on to lo-fi beats. And then there's auto insurance, which is apparently the life of the inflation party, spiking at 21%. Picture auto insurance as the uninvited guest who not only crashes your party, but also eats all your snacks and spills soda on the carpet. But don't worry, this party crasher's antics are set to calm down soon, and once they do, we'll see what Lee calls the median inflation settling at a much more civilized 1.8%. Despite these quirks, Lee's message is clear: don't let the noise fool you. The stock market is poised to shine brighter than your neighbor's holiday lights. Real-time indicators like cooling housing and rental prices are painting a much rosier picture than the official stats. It's like checking your watch to see the time, but still relying on a sundial in the garden. Modern problems require modern solutions, folks. Speaking of modern solutions, recent reports show that inflation is taking a chill pill. U.S. consumer prices in April increased less than expected, suggesting that inflation is finally taking a breather at the start of the second quarter. Imagine inflation as a hyperactive puppy finally tiring out after a long day. Cute, right? This development boosts market confidence and hints at a potential interest rate cut by September, giving us all a reason to smile. Meanwhile, retail sales decided to take a nap, showing no growth. While this might sound alarming, it's actually a sign that domestic demand is cooling off, aligning perfectly with the Federal Reserve's goal of a soft landing for the economy. Think of it as the economy gracefully parachuting to safety rather than crash landing into a recession abyss. Lee's optimism isn't just based on wishful thinking. He argues that as real-time price trends start to reflect in official reports, the stock market's outlook will brighten significantly. It's like waiting for the clouds to clear so you can finally see the fireworks display. And trust us, it's going to be spectacular. Interestingly, market sentiment is cautiously aligning with Lee's predictions. The CME FedWatch tool now indicates expectations for 1 or 2 rate cuts by the year's end, a stark contrast to the 7 anticipated at the beginning of the year. This shift underscores a broader market belief that inflation might retreat closer to the Fed's 2% target sooner rather than later. However, the Fed's next moves are critical. With current interest rates perceived by some, including Lee, as excessively high, there's growing concern that prolonged restrictive monetary policy could inadvertently tip the economy into a recession. It's like walking a tightrope. One wrong step and it's a long way down. Lee's bullish stance isn't just based on economic indicators, but also on a broader financial context. He predicts a significant rally in the S&P 500, suggesting it could soar by an additional 6% to reach 5,500 by year's end. If realized, this could mark one of the more dramatic recoveries in recent times, potentially validating his optimistic outlook amidst a sea of caution. Building on Lee's recent statements, the latest Federal Open Market Committee (FOMC) meeting offered 5 key signals that indicate a more dovish approach moving forward. Slowing quantitative tightening. The Fed plans to reduce balance sheet contractions from $60 billion to $25 billion a month starting in June, a move designed to slightly loosen financial conditions, a boon for the markets. Declining inflation. Although inflation rates were higher than expected throughout the first quarter, there's an observable downward trend. March saw consumer prices rise by 3.5% year over year, a significant drop from the mid-2022 peak of 9.1%. Coexistence of rate cuts and a strong labor market. Contrary to concerns that a robust labor market would prompt the Fed to raise rates, Chair Jerome Powell highlighted that a strong job market doesn't preclude the possibility of rate cuts. Staving off stagflation. Despite earlier fears of stagflation, Recent data showing solid economic growth and robust consumer spending suggest that the U.S. economy remains dynamic and resilient. Unlikelihood of a rate hike. Powell's remarks reassured investors by downplaying the likelihood of an impending rate hike, calming fears about potential tightening that could stifle economic strength. And let's not forget Bitcoin, the wild card in Lee's deck. He predicts striking rebounds in 2024, fueled by the Bitcoin halving event and technological advancements. It's like finding a surprise bonus level in your favorite video game, unexpected but thrilling. As we monitor these developments, the interplay between real-time economic data and official statistics will be crucial in shaping both Federal Reserve policies and market trajectories. So grab your popcorn, sit back, and enjoy the show. Because if Tom Lee's predictions hold, we're in for a blockbuster second half of 2024.